Good afternoon, everybody, and welcome to the latest in our series of professional advisors working lunches, today brought to you courtesy of our partner, Baillie Gifford. I'm Hope Williams-Smith, editor of Professional Advisor, and I'll be your host for the next hour. Before we get going with today's session, let me quickly run you through the usual housekeeping. So your microphones and cameras are currently switched off, and we'd be most grateful if you could keep them that way, just to ensure there's no background noise and so our speakers can be heard more clearly. I should also inform you that this session is being recorded and we will send you a link of the recording by tomorrow. Do feel free to share this with your colleagues. And as usual, today's working lunch will qualify for 1 hour of CPD, and we'll be sending your proof of attendance along with the link of the recording to the session by email tomorrow. Now, I don't need to tell you that in recent times, there has been a great deal in the media about what's happening at Scottish Mortgage. So today, I'm delighted to be joined by Claire Shaw, who is an investment specialist at Scottish Mortgage. Over the next hour with Claire, we'll learn how the Scottish Mortgage team is managing the portfolio through this challenging period. And Claire will explore why Scottish Mortgage believes that investing in radical innovation and companies building the future of our economy matters irrespective of the macroeconomic backdrop. Do feel free to put any and all of your questions to Claire using the chat function, which you'll find at the bottom of your screen. If you wish to remain anonymous, then simply select my name from the drop-down list in the chat box before you type your message, so only I can see it. Now, just before I hand over to Claire, let me quickly run you through our learning objectives for today. So by the end of this session, you should be able to understand the unique philosophy that sits at the heart of Scottish Mortgage, understand why long-term structural changes in society are more powerful drivers of change and disruption than macroeconomic or geopolitical issues, and why it is rational to seek out the exceptional companies driving this change to maximise your chances for growth over decades. And finally, to understand why the current environment leaves room for optimism for investors willing to take a long-term patient view. So that is the CPD all covered. So let's hear from Baillie Gifford's Claire Shaw. Good afternoon, Claire.
Hi, Hope. Thanks very much for having me. I will just share my screen, hopefully. Hopefully everybody can see that on screen now. Super. So in terms of the purposes of today's presentation, I just wanted to touch on 3 areas. Firstly, on the market environment. Secondly, on private companies. As Hope mentioned, this is an area that's been getting a lot of attention in the media and press recently. And then sort of finally, just sort of looking ahead and looking at why we're excited and where we see opportunities. So maybe just starting on reflections on 2022. It's no surprise it was a difficult 12 months for growth equities and Scottish Mortgage in particular. But if you take a step back from the noise that we saw in the financial markets, we actually think there was quite a lot that the market overlooked. And against that backdrop, I think it's really important just to sort of frame the fact that, despite all these macroeconomic and geopolitical shocks that we had, we've really not changed our investment philosophy. The process. I'm making it up on my word. Me feel this is probably it. I think somebody's maybe not on mute on the line there. Apologies. So I'd say against the backdrop of all the uncertainty that we had in the market, I think it's really important just to say that nothing has changed in our investment philosophy. But probably more important than that, I think it's really important to mention that there was actually quite a lot of really significant and quite exciting progress that actually did happen last year. So you take something like Moderna, which is our biggest holding in the trust. They announced a potentially game-changing vaccine for cancer, where they'll actually have personalized cancer vaccines. And this showed a 44% increase in survival rates. This is game-changing in terms of how they Swedish company making batteries for electric vehicles. they're fast becoming Europe's regional champion in an industry that's dominated by the Asian players. This is a company that's now got an order book of over 50 billion from all the major OEMs, in Europe. SpaceX, we saw last week the phenomenal sight of Starship, the world's largest and most powerful rocket, take off. Now, obviously, although the rocket failed to separate, resulting in self-destruction, from a SpaceX point of view, this was very, very successful because of the data, the valuable data that they were able to gather from that. But also, when you look at last year, SpaceX made over 60 launches. That's over one a week. They've now probably commanded about a 70 to 80% market share of the launch market. And there's countless other examples that we can really look to. So I think what this kind of first point we're trying to make is that, despite the stresses and difficulties of the backdrop, we are staying true to the core kind of approach of Scottish Mortgage. What is it we're trying to do? We're trying to find companies that are driving that radical change. And because we're looking, that change is so extreme in terms of what we're looking for, we believe that the impact of what they're going to do over time is going to be valuable, irrespective of that kind of broader macroeconomic context. However, I think it's important to say that when we look at Scottish Mortgage as a whole, we don't actually see a break or any change in the deep trends that we think underpin much of the portfolio. We've held this view for a number of years that we think there's these three big drivers of change that are going to dominate the portfolio over the next decade. It's the energy transition, so it's this move from carbon to renewables. It's the intersection of healthcare and technology. And it's that sort of continuing digitalization of the economy. So I would say that the structural shifts that underpin our holdings, we think are going to continue whether we're in a recession or not, whether interest rates rise or fall, irrespective of what inflation are doing, because the great companies that we're investing in, we think will make progress even in those difficult environments. But I think it's important just to talk about what's obviously been happening in terms of growth per se. And as I mentioned at the beginning, it's been a difficult environment for growth stocks, in particular long duration growth equities. But if we dig a little bit deeper in terms of trying to deconstruct, what does it mean by growth? I think we can shed some light behind that kind of roller coaster performance of growth stocks over the last 3 years. And in particular, what's sort of been behind maybe some of the slowing growth numbers we've seen over the last sort of 12 months. So the way I sort of contextualize this is, I think there's two distinct buckets of growth. You've got structural growth, which is really what we care about. This is the growth that generates those long-term outlier type returns that we really seek. This is the growth that companies are generating by, disrupting industries. This is that kind of technology-driven transformation that many of our holdings are driving. So that's the kind of first bucket. Then you've got the second bucket of growth, which is the cyclical growth. This is, the growth associated with the business cycle.
I'm self-employed.
I think somebody's not on mute again, apologies. And this cyclical growth bucket, I would say, has gone from being a tailwind to a headwind for Scottish Mortgage over the last sort of 12 to 18 months. And it's really the reason of why we've seen some of that slowing growth. The cyclical component, if you like, has come out of many of our holdings. And just to give you a sort of sense of what I mean by that, I think the tech sector is a good industry in which we can really see that cyclical growth, that reversal from the tailwind to a headwind. So if you cast your minds back a couple of years, you had all the big tech companies in Silicon Valley adding 5,000, 10,000 new staff members a quarter. Those new staff members needed software, which they got from the cloud computing companies. The cloud companies saw their seat growth rapidly accelerate. What we've seen more recently in the last kind of 6 to 8 months is, as many of those big Silicon Valley giants have started to shed their staff, that kind of seat growth has reversed at the cloud companies, and you're seeing that kind of self-referential cycle that we've been a beneficiary of reverse. But I think the key thing just to say is that, that doesn't really worry us. That kind of cyclical growth, if the growth is slowing because of cyclical factors, that's not a reason for us to change our mind. Reasons for us changing our mind about an investment doesn't include those near-term fluctuations. Because again, to come back to the kind of first principles of Scottish Mortgage, what is it we're trying to do? We're trying to own the best growth companies in the world. We're not trying to own these average GDP plus businesses. our focus is on those businesses with those secular growth opportunities, who in the long term are going to be beneficiaries of this disruption. And I guess that's not to say that our holdings are not going to be immune from this environment that they operate in. Some obviously will produce lower rates of growth, and that's fine. But I think it's still okay if we see that kind of long-term structural opportunity. That's really what we care about. And then maybe just pivoting on to the kind of environment that we find ourselves in at the moment. I think it's safe to say that growth companies, have really had this period of, they've been allowed to have profitless growth. You've had abundance of capital. And what we're really seeing is this now change. We now think that our companies and our management teams are accepting that capital environment has changed. Previously, companies were happy just to focus on revenue growth, and they were very much loss-making by choice. Now we think very much the case that companies are wanting to be in control of their own destiny. They're very much wanting to focus on not only revenue growth, but that kind of profitability factor as well. And I think there's a couple of examples we can mention here, whether it's Cloudflare, who I mentioned earlier in the kind of cloud computing space. Shopify are now are pivoting their business much more towards focusing on their operating expenses as well as their top line. Spotify, a similar story. So I think it's a safe sort of conclusion to draw that our companies and our management teams are really kind of acknowledging that environment has changed. And I think going forward, when we're in this potential environment of capital scarcity as opposed to capital abundance, then you're going to see that kind of profitability focus come much more into play. So that's really the kind of main things on the kind of current environment. I thought it would be a worthwhile exercise just to touch on the private companies, because as Hope mentioned at the beginning, this has been an area that's dominated a lot of the media and press attention over the last few months. And so I thought it'd be useful just to do a recap of where we are with our private companies and our exposure. So in terms of a good place to start, I think it's useful maybe just to talk about why we're invested in private companies. And I think the first thing to say is that for Scottish Mortgage, the rationale for investing in private companies is because we want to give our shareholders access to a range of businesses, many of which have no public market equivalent. So I've mentioned two already at the top of the call, SpaceX and Northvolt. We think these assets are some of the most exciting companies in the world right now, and there is no public market equivalent of Northvolt and SpaceX, but I could also mention countless others. But I think the other reason to mention of why we invest in private companies is that, again, coming back to the rationale for holding Scottish Mortgage, is if we want to own the best growth companies in the world, we have to have the broadest opportunity set. So that means being able to own both public and private companies. And because private companies are choosing to stay private for longer, more of that value is being created prior to a company listing. And we want to give our shareholders access to that value being created. So I think it's just important just to say at the outset that that's the rationale. That's why we invest in private companies. You've got these unique assets, and companies are choosing to stay private for longer. And the vehicle that Scottish Mortgage offers shareholders is access to these companies, but at a very, very competitive cost. However, I think maybe just coming back to what's been on people's minds more recently is talking about our exposure to private companies. And just in terms of where we are, in terms of the limit and the cap that we have, the limit for private company exposure for Scottish Mortgage is at 30%. What this graph shows you here is how that's evolved over the last sort of year or so. So you can see, roughly a half to 2/3 of the time, we were below the line, we were above the line the other portion of the time. I think the key thing to take away from this is that when we are above the 30% cap, we don't become forced sellers. We don't have to trim any of our private company exposure. We don't have to sell down anything. What it means in practice is that we just cannot participate in any new funding rounds or buy any new additional private companies. But it hasn't been a constraint for us, for the reasons being that very few companies have actually been wanting to raise money last year because of the market environment. And I think that 30% cap, there's a few components to it. I think there's been a lot of worry about that 30% cap. But when we break down the factors that determine our exposure, I think there's three things really to sort of pick out here in terms of what's important. So what dictates our percentage of private companies is three things really. It's first of all the number of new buys that we're buying that are public versus private. You can see last year that was roughly 50-50, so half our new buys were private, half our new buys were public. The second thing that determines our exposure is the performance of public markets relative to private. You can see in the chart in the middle there the average write-down of our private companies versus the NASDAQ, which is often used as a proxy for Scottish Mortgage. You can see the average change in our private companies was about 34%, which is pretty much bang in line with the NASDAQ. If you exclude the companies that were written up, the average write-down was about 44%. But the key reason for that 30% limit, we're bumping up against that limit, is that third factor, which is the fact that IPO activity really ground to a standstill last year. So Scottish Mortgage had no companies making that transition from private to public during the year. And that's really important because that acts as like a natural offsetting factor to that limit. So when you've had one of your factors that naturally bring your exposure down, essentially just been evaporating, that's really probably one of the big reasons that we're at that kind of upper end of our limit. There was, I'd say, very, very little IPO activity last year, if any. And then I think it's also important when we're thinking about private company exposure is maybe just debunking some of the myths, I would say. The chart on your left shows our private company exposure. So we have 52 private companies, which account for just under 30% of Scottish Mortgage. But what I think may come as a surprise to a lot of people is that actually it's really 5 companies that matter. 5 companies account for about 50% of our exposure. You can see them listed there: the SpaceX, Northvolt, ByteDance, Brandtech Group, and Tempus. And I think what's important there is, again, it's really coming back to those the principles of Scottish Mortgage. We're looking for those companies that are going to be the next big winners. Those companies that are going to dominate their industries and disrupt their industries. And we think companies like SpaceX and Northvolt and ByteDance, are great examples, of companies that are potentially going to go and do that. So when we look at our exposure overall, it's really, I think, important to say that, yes, we might have 30%, there's 52 investments, but really these 5 companies are where the majority of our exposure is. And you can see there on the table at the bottom, the top 10 is about 2/3 of our exposure overall. So maybe then just sort of looking ahead to the kind of opportunity set, touching on maybe on what I said earlier about the markets being difficult for growth equities. When you actually look at the last sort of 10 to 15 years, it probably has been conducive for growth equities for 3 reasons. You've had low levels of discount rates, low levels of interest rates, you've had expanding globalization, and you've had a high level of technological innovation. What I would say in the last couple of years is we've seen a significant shift in the first. We've seen interest rates rise at a phenomenal pace. We've seen significant risks emerge in the second, that expanding globalization. We're now probably moving more towards a phase of deglobalization. But the third variable, that kind of technological innovation and that kind of drumbeat of underlying technological process, has continued to accelerate. And so just to maybe reiterate what I said at the beginning, we don't see a break or a massive change in those deep trends underpin the portfolio, whether it's the energy transition, whether it's the intersection of healthcare and technology, whether it's the digitalization of finance or food or the enterprise. We still think that these areas hold massive promise. And while this progress maybe hasn't been reflected in the investment results of these companies of late, we think you have to remain disciplined and patient because, as I say, these themes we think will come through. And I think, again, it comes back to when we're trying to say that we're wanting to own the most exceptional growth companies, how do we define this? So for us, the power of truly great businesses are ones that reinterpret the industries in which they operate in. And we really know that change drives growth. So for us, it's about imagining, what if rather than what is. So let's take transport as an example. What might the future of transport look like? You might land at Heathrow Airport and take a Joby flying taxi, to get out down to Kent or to Sussex. Instead of a postman delivering your Amazon box, you may have a zipline drone who'll drop it off in your backyard or your front door. What might the future of healthcare look like? We already have had a glimpse of this with Moderna and having personalized cancer vaccines, based on your own genetic makeup. This is game changing, in terms of how we treat the kind of second biggest killer in the world. You look at an industry like energy, how could we decarbonize some really dirty industries? Let's take the chemicals industry. Solugen, one of our companies, they're trying to change the way chemicals are made by using bio-based inputs instead of fossil fuels. So I think the point we're trying to make with this is that what Scottish Mortgage does is, we're not investing in the status quo. We're not investing in the old ways of doing things. We're investing in, new ways of doing things. And sometimes this can feel safe and reassuring. We think it's probably anything but that. And I think it's important for us to sort of embrace change and embrace that sort of, and embrace the possibilities that we see. And then I think maybe just to sort of conclude on sort of presentation part, I think what we're witnessing right now is in an environment where you have fear and a lot of noise like we've seen recently. Investors are flocking to the assets that are already proven and profitable. Anything that looks like the big hitters of the last decade, people are much more comfortable with, because that predictability can have a kind of quite a deep allure, if you like, as uncertainty grows and people become more fearful. But from our perspective, we think investing in those assets, it might be appropriate for others, but we're skeptical our shareholders will benefit if in the long run we can resort to sort of following the crowd, if you like. And so buying that predictability might provide temporary comfort, but I think from our perspective, by embracing the discomfort, we can entertain that possibility of outsized returns to find these, exceptional growth companies. And I thought it was interesting just putting this in the context of looking at innovation more broadly. So if you look in the last sort of 40 years or so, in many industries where you've seen disruption, it hasn't come from the so-called experts. Experts may be the most likely sources of those incremental advances, but radical rethinks often tend to come from the outsiders. So if you look in the retail industry, it wasn't Walmart that innovated retail, it was Amazon. If you look in the media industry, it wasn't CBS or Warner Brothers, it was Facebook, it was Twitter, it was YouTube. In the auto industry, it wasn't the established OEMs, it wasn't GM, it wasn't Ford, it wasn't VW, it was Tesla. In space, we're talking earlier, it's not Boeing or Lockheed, it's SpaceX. So then I think if you look to the next 10 years, looking ahead, we look at healthcare, it might not be the established pharma companies, the safe havens of Novartis and GSK and Johnson & Johnson, maybe it's Moderna with what they're doing with mRNA. If you're trying to build a logistics company, do you want a logistics CEO or do you want someone like Keller Renado of Zipline, who is completely rethinking the future of logistics by using drones to deliver everything from healthcare to your groceries to food delivery. Similarly in the food industry, it's not Nestle or Tyson Foods that's innovating food. It's maybe a company like Upside Foods, who are one of the companies at the forefront of the cultivated meat industry. And so I think from a Scottish Mortgage perspective, what we're excited about is really sort of backing these founders and entrepreneurs who are trying to disrupt these industries, who we see these are massive industries. You know, foods, meat's $1 trillion industry. The logistics industry is massive. You know, the potential to find a cure for cancer and healthcare. These are huge market opportunities. And we think the companies in the portfolio are well positioned to exploit those opportunities, and hopefully, you know, that will generate exceptional returns for our shareholders. So I think that's about maybe half an hour. Hope I will maybe stop my presentation there, and I'll open it up for some questions if anybody has any.
Thanks so much, Claire. Quick reminder to everybody, if you do want to ask a question, now is the time. You can send them to me directly in the chat if you would like, and we'll get through what we can. So Claire, just to kick things off, as you alluded to, growth equities have, of course, had a really tough ride as of late, and yet you are still positive. So I was wondering if you could please break that down a little bit more around your thinking on growth stocks and dive a bit more deeply into some of these drivers of growth.
Yeah, I mean, I think it comes back to just like back slide here. Wrong way. The joys here. I think it comes back to what we said we were trying to do. You know, we're trying to back those companies that are really trying to change their industries. And I think when you look at this chart here, I think it just really shows you, you've called it the engines of growth, you know, whether it's in transport or in media or in retail or in food or in finance. If you look at all these themes here, you know, we're massively excited about what's actually happening under the bonnet in these companies and in these industries. And as I mentioned earlier, Hope, you know, our companies are very much on the right side of those structural changes. You know, when we look at our companies, the founder-led businesses, the culture they're installing in their businesses, the growth that they see, you know, not just a couple of years out, but decades out, you know, that's what really, really excites us. And I think the other thing to mention as well is that, you know, the types of companies that we're investing in, you know, we're very comfortable with the fact that progress is not always in a straight line. You know, for any of the exceptional companies that we've invested in over the last, you know, decade or so, there has been periods of immense volatility. I've got a slide in here on this that might be through here. Yeah, maybe this is a good slide just to touch on. When we talk about value creation not being linear, you know, the biggest outliers are often the most volatile. You know, this chart here shows where most of the Scottish mortgage returns have been generated from over the last 10 years. You see the big names in there: Tesla, ASML, Nvidia, Facebook, Amazon, and Tencent. But you can see on the line underneath just how many drawdowns they've had over 10%, you know, some, you know, in excess of 50%. And I think we're okay with that. You know, as I say, you know, we're very comfortable with this notion that, you know, extreme returns and smooth performance are mutually exclusive. And I think that kind of long-term time horizon that we have is really very much our distinctiveness and edge versus the rest of the market. And so in tough times like we're seeing at the moment, I think that patience, you know, that patience that we have, and, you know, really seeing through the kind of short-term challenges with our company really is an edge versus others.
Thanks, Claire. Well, someone's got a great question here, picking up on when you were speaking earlier about Tesla. And they've asked what your thoughts are, and, you know, what the big disparity in the holdings is when we think about things like the EU backtracking on electrification, hydrogen perhaps taking over battery technology already. So just some of your thoughts on that.
Yes, I think the point is, you know, we remain to be, you know, very excited about, I'm just going to see where it is there on the charts. You know, we are still very, very excited about Tesla and the progress that they're making. You know, when you look at the operational performance, you know, this is not a company that is demand constrained. You know, I think, if I'm right in thinking, the last results, the Model Y is now the best selling car in Europe, which is a phenomenal statistic. So I think when you look at Tesla, you know, they're still aiming for that 50% top line growth. They're now in a position where, you know, they are driving that growth forward. They have seen some issues around the margin, but I think that because their margins are so strong anyway, they can absorb that probably better than most. So it remains, a very high conviction name for us. Tesla, you can see there, it's the third biggest holding in the portfolio at the end of March. And yeah, we continue to be very excited about it. And when you look at the growth rates of EVs, not just in Europe, but globally, we think that trend towards electrification will continue. And that's probably backed up by what we're hearing from companies like Northvolt, who have all the OEMs sort of clambering over themselves to try and secure capacity for lithium-ion batteries, which is what Northvolt's producing. So we have other companies at various other parts of the value chain. And I think our overall thoughts is, that kind of the demand remains very, very strong for that electrification theme.
Fantastic. Well, we've got quite a few good questions coming in here on private markets, but just to start things off, Claire, I wanted to ask you whether you think private companies are under pressure when you consider that we've moved now to a more, I guess, capital scarce environment.
Yeah, I think, I mentioned earlier, the capital environment is obviously changing for both public and for private companies. As I say, for the last decade, financial markets have tolerated this period of profitless growth. And this has changed. Companies can't burn cash and expect the market to give them more. And so I mentioned a few companies on the slide earlier, which were the public companies, where you're seeing this move towards more pragmatic and adapting their business models. I think we would say that we're seeing a very, very similar trend in our private companies as well. What they're really wanting to try and do is extend their cash runways. So if you roll back maybe 18 months, 2 years, a lot of our private companies were pursuing, many growth opportunities. They had lots of avenues of future growth. And they were probably quite happy to go after, numerous of those growth opportunities. I think what we've probably seen in the last maybe 12 months is companies in the private space being probably more selective with what growth they're going after, really with the purpose of extending that cash runway. And I would say that's probably been the biggest sort of change that we've seen. But maybe just taking it back to from an SM perspective, when we look at actually the health of our portfolios, our companies remain well capitalized. Most of our private companies have over a year of cash runway. A number of them are actually cash generative, which might be a surprise to a few. But it's something that we monitor a lot. We're looking a lot at the health of our portfolios, the robustness of our portfolios. And from a private company perspective, I think that they are really making sure that they've got enough cash on hand so they can really sort of go after the growth that they want.
Excellent. Well, just following on from that quite nicely, somebody has asked what percentage of private companies that you've held have failed over the last 5 years?
Has what, sorry?
Failed.
I don't know about any that have failed. There's been obviously some big write-downs in the value of those companies. And there's only one from memory that we've probably written down to zero, and it was a tiny position. Anyway, but yeah, as I say, but that's not to say that there might be more, going forward. I think we're quite pragmatic about the environment that we find ourselves in. And again, I don't think it's really different talking about the public companies, the private companies, like the slide earlier showed, it's a small number of companies that really dominate returns. It's those companies that we're trying to find. And that's the same whether it holds in the private markets or the public markets. So there might be some of our public companies that don't work out. In fact, many of them probably, fail to really generate that kind of exceptional returns that we're looking for, and that'll be the same whether they're public or private. So really it's about finding that handful of big winners. And when you look at the portfolio today, you can see here, SpaceX and Northvolt are in our top 10. These are not small companies. A lot of our companies are actually large established businesses, several $1 billion of market cap. And so I think that in terms of, and this is maybe just not to confuse what we're doing in private companies, these are big established global businesses. But yeah, as I say, they're the environment that we find ourselves in, there are going to be companies that struggle, and I think we're okay with that.
Thanks, Claire. Well, touching back on the theme of innovation that we've spoken about quite a bit this afternoon. Someone has said innovations and new digital things or themes can often flop or run their course quickly. So how do you determine a player that's going to be big enough for long enough?
Yeah, that's a good question. I think a lot of what we're doing is looking at companies, as I say, that are trying to disrupt industries. And I think one of the first things we look at is the founder. I think from memory, I think just about 80% of the Scottish mortgage holdings are founder-led. And I think why that's important is it enables companies to have a long-term time horizon so they can really try and exploit that disruption. You know, these companies are really focused on that long-term potential opportunity set that they see. And so I think by having that kind of founder-led business is really a really important aspect and facet for our companies. But yes, of course, there's going to be companies, I'm just going to go back to the slide that had, there's going to be things that are a fad. But if you look right now in terms of just how many exciting areas of growth there is, you know, whether it's genetic sequencing, whether it's robotics and 3D printing, whether it's artificial intelligence, which is obviously all over the news right now, you know, there's several areas where we think there's just so many exciting trends that are, you know, we can exploit, we can take advantage of, and we can really generate, you know, really kind of find these exceptional companies that are trying to do something quite different. So I would say that when we're looking for when we're certainly looking for the companies that we invest in, for us, it's about, can that company address a big enough market opportunity? What is it they're going after? Can they really disrupt an industry? And often what we find is that if you look at the companies that we, you know, looking at examples there, SpaceX, Tesla, you know, Facebook, Amazon, these are all founder-led businesses. You know, there's a pattern here. And like I said earlier, you know, the experts tend to make some changes around the fringes, but it's really these new thinkers that come in and disrupt the industries. And I think that's really where we get excited about, is going and speaking to these new founders. You know, many of them are in the private space to begin with. And that really offers us a lens into the future. I think it's quite an important, again, advantage of Scottish Mortgage, is that by having this crossover portfolio between public and private, you know, we can see the themes in the private space that, you know, are potentially going to come through in the next 5 to 10 years. So whether that's synthetic biology, or whether it's quantum computing, or whether it's any blockchain technologies, you know, we're seeing these businesses sort of incubate in the private space. You know, we're seeing the trends coming through. And by having that kind of lens into the future, it's really helping shape our thinking in terms of what is going to be those big drivers of innovation over the next 5 to 10 years.
Great. Well, speaking of innovation and perhaps taking it the other way, someone has said, is there any place in Scottish Mortgage for traditional energy and traditional pharmaceuticals?
Yeah, I mean, it's hard to say. I mean, never say never. I mean, again, come back to what is Scottish Mortgage trying to do? It is trying to find the most exceptional growth companies in the world. And when I say we're trying to find the most exceptional growth companies, you know, this isn't about, you know, average growth. This isn't GDP plus growth. Just, you know, I've got a slide in the presentation that has the growth rates of it. I don't know if it's in here or not. That's why I flick through. No, I don't think it does. And so it is never to say never that we don't own a big energy company or a big pharma company, but we're talking about disruption. We're talking about disruptive innovation. We're talking about companies that are redefining industries. You know, that kind of change drives growth mentality. And so when you have that framework and you have that process, and then you try and overlay, you know, a traditional energy company or a traditional pharma company, you know, it's sometimes difficult to make that outlier case. You know, can that company grow 5 times from here? You know, has it got that exceptional opportunity that we're looking for? And when you think of our hurdle, you know, we've got quite a high hurdle in terms of that growth. You know, competition for capital is high. And so it's not a case of we don't think that's a good company or a good business, and it's got a place in many people's portfolios, of course. But what we're trying to offer is something different. You know, Scottish Mortgage, you know, let's be honest, is not for everyone. It's a portfolio where we're very honest. you need to have that long-term time horizon. You need to look at things, on that 5-year basis, because we're trying to go after those exceptional winners. So those companies absolutely have a place in portfolios, but for us, it's not what we're trying to do. We're trying to find that small number of big winners, and there's going to be volatility along the way. And as I said earlier, we're okay with that. So I guess that's a long way of saying never say never. But the growth that we're looking for typically has a higher hurdle, and it's difficult to get those companies to work on that growth that we're looking for.
Claire, are there any private companies in particular at the moment that are piquing your interest looking ahead for the next few years?
Yeah, so I probably mentioned a couple of them already. I mentioned Northvolt, and obviously I mentioned SpaceX. I think other ones to mention is potentially Zipline. I think I mentioned them briefly earlier when we were talking about the future of logistics. So Zipline, sorry, going the wrong way here. Zipline is a company who essentially are using drones to redefine the logistics space. Now, this has got a really interesting backstory whereby the business actually started off in sub-Saharan Africa, delivering blood to hard-to-reach places in Rwanda and Ghana. And this blood that they were delivering via drones was saving, many, many lives. The business then evolved to delivering COVID vaccines, during the pandemic, delivering cancer medication when people couldn't travel and were in lockdown. And Zipline's now in a position whereby they're now signing contracts in the US with the likes of Walmart to help Walmart deliver their packages and foods. They've signed up with Sweetgreen, which is a food delivery company delivering salad bowls. So Zipline's a company we think that's got an enormous opportunity set in terms of that kind of logistics market being so big, and it has really been dominated by on the ground trucks. And now what Zipline are doing is having these little drones fly around and dropping little packages in people's backyards and doorsteps, which we think is a phenomenal company. So I think Zipline's the one I would probably say is one that holds immense excitement for us. And for those that are interested, we actually had, we have recently done a Scottish Mortgage podcast, and we actually had the founder of Zipline on, and it's fascinating just listening to the story of where it's come from in terms of having that roots in Africa and where it's come to today, signing contracts with Walmart. So I'd encourage anyone to listen to that, because it's a fascinating story, just hearing about one of these companies and one of these founders who we're really, really excited about.
What will they think of next?
Indeed.
We've got a really good question that's coming here from one of our listeners this afternoon that says, how confident are you in the value of the private companies? Is it an accurate reflection of their market value and NAV?
Yeah. So I think just coming back to sorry, it keeps going the wrong way this time. Where's the numbers there? So in terms of the confidence and the valuations, I think that slide in the middle really says quite a lot in terms of how much we've marked our companies down by. So if we take it a step back and think about Scottish Mortgage as an entity, we are a daily listed, fund. We have a NAV that we release daily. So we want to make sure that there's kind of no stale prices in our NAV. So, we make sure that any changes that has taken place in our companies, particularly in the private space, is reflected in the NAV the very next day. So I think that's the first thing to say, is that from a robustness of process perspective, we really want to make sure that any changes in the valuation of these companies is reflected in the NAV. And this is obviously quite different to the rest of the sort of private equity space, where they tend to value things, whether it's on a quarterly or 6 monthly or annual basis. So from our perspective, there is no sort of delay in that. The other thing I would say is that when you actually look at the quantum of revaluations that took place last year, there was something like circa 500 revaluations taking place across our private equity book. Now, if you think that the normal, if you want to call that an inverted commas cycle, is that we revalue our companies on a kind of 3-month rolling basis. So every company sort of revalued on that basis. Where we've had more valuations take place last year is that when there is sort of bigger moves in the public markets and public listed peers, that will trigger what we call that will warrant a trigger event. So we'll look at the holding value of our private companies on that basis. And so when you take that all into consideration, the fact that we had so many trigger events last year because of the underlying volatility in the public markets, we had that kind of 500 valuations take place. I think from memory, just over 70% of our private companies were valued more than 5 times. There was maybe 85% valued more than 4 times. So you can really see from again, that process perspective, you know, we are trying to ensure that the value that we're holding these companies are as close to fair value as possible. You know, we really are trying to ensure there is no stale prices. And when you see the number of revaluations that have taken place, you know, the majority over 5 times, that hopefully shows that, you know, there is, you know, there's quite a lot of attention, you know, on the carrying value of these companies. And then when you see on this chart here that we've pretty much written them down, you know, more than the kind of market, that hopefully kind of proves that, you know, we're not holding these assets at, you know, an elevated level. You know, yes, there might be still some downwards trending to go in some of these names, and I'm sure there will be. But when you look at how we've written our companies down versus the market, hopefully people can take some comfort. As I say, we have got quite a robust process around this, and there's been a lot of attention and efforts going into making sure they are held at fair value.
Thanks, Claire. Well, we've got quite a hard-hitting question here in terms of liquidity in the fund. Someone has asked, how do you answer calls when there is no market for the sale of private investments?
Can you repeat the question? Sorry, Hope.
How do you answer calls when there is no market for the sale of your private investments?
Yeah, it's an interesting question, and it's a very valid question, and it's something we actually ran analysis on actually a few weeks ago, which is actually there is quite a buoyant secondary market for a number of our holdings. So even in the first quarter of this year, I think there was like secondary market activity in just over 50% of our book. And that's just in a very short time span. That's just in that 3-month period. I'm sure if we extended that time period for longer, obviously that number would expand. So in terms of the activity, there is actually quite a lot of secondary market activity, because it comes back to that point I made at the very beginning about the assets that we're investing in. You know, these are assets that people want. You know, SpaceX is a company that excites people. Northvolt's a company that excites people. You know, ByteDance is probably one of the most phenomenal businesses that we've seen in a very, very long time. Stripe, we've just seen Stripe raise $6.5 billion. You know, in the private markets. You know, these are not small companies. Epic Games, Zipline. You know, if you look at the narrative surrounding these companies, there is demand for the assets because they are such differentiated assets. They are good business models. They are companies that people see as having, you know, that exciting growth runway. So actually, from our perspective, you know, we could sell these assets. You know, we could sell some of it in the secondary markets, but at this moment in time, we don't want to, because we actually think that obviously the long-term potential for them is there, and we want our shareholders to benefit from that. So, excuse me, it's not the case that we're stuck in these names. Excuse me. I'm not sure, Hope, is there any other questions on the line there?
Yeah, we've got a couple of others here, and I think there's one that does keep coming up quite a bit, which will not surprise you. Of course, it's not gone unnoticed that there have been quite a few comparisons made between Scottish Mortgage and Woodford, and naturally anyone caught up in the Woodford fund will have their concerns. So could you speak a little bit about this, please?
Yeah, absolutely. And I think that Woodford hangover, you know, still lingers in people's minds, understandably. I think there's probably 3 big differences between Scottish Mortgage and Woodford, and I've probably touched on a couple of them already. So the first thing is the size of the holdings. The average size of a Scottish mortgage private company is about $10 billion. The average size of the companies held in the Woodford Fund was about $200 million. So there's a huge difference in the size of that company. So I think that's the first thing to mention. There's a big difference there. The second thing to mention is, we are a global trust. We're investing in the best businesses, best private businesses all around the world, whether that's in the US or China, UK, whatever it may be. Again, Woodford is very much that UK focus. I would say that's the second thing. And then the third thing, which is probably the most important thing, is actually the structure. We're a closed-end fund. Woodford was an open-ended vehicle. And so what that means in practice is, we're not forced sellers in the same way that Woodford was. And so I think when you actually put those three factors together, it's a very, very different beast to what we are, whether it's the size of the companies, the geography or the structure. It is very, very, very different to the Woodford situation.
Great, thanks, Claire. Really appreciate that insight there. Now, as we come into our last couple of minutes, just a quick reminder that it's your final chance to get in any burning questions that you have. And a good one here to start our last little section, Claire, is what do you see as being Scottish Mortgage's biggest challenge in the next 12 months and then also in the next 3 years?
Yeah, it's a good question in terms of the challenge. What's the biggest challenge? I think we have to be quite honest about the fact that, we can't control the geopolitical situation. We cannot control the macroeconomic outlook. We have to be patient. We are long-term holders. And I think that's probably sort of setting the scene of that in terms of a challenge is that, it's just really trying to ensure that we remain patient, our companies remain patient. I think that's really the key thing. I think our probably biggest task actually is keeping management teams really focused on going after that growth opportunity. It's very easy when you're in the eye of the storm to really resort to the safe havens, to pull back, if you like. And I think maybe our challenge is, if you like, is actually making sure we're still encouraging our management teams to take those risks, to go after those opportunities. Yes, we're in a different environment, but that doesn't have to come at all costs. I think I said earlier, we have to have that pragmatism in terms of what we're operating in. So I think over the next 12 months, it's our job is very much, we see ourselves as partners to our companies as opposed to shareholders. We're in it for the long term. We're very philosophically aligned with our companies because they're founder-led. We can have those robust conversations. And so I think the challenge for us is hopefully helping our companies remain focused on the bigger picture and make sure that they're not sacrificing, growth at all costs, and still encourage them to actually take those risks and go after those exciting opportunities.
Great. And moving from risk to opportunities, Claire, what themes do you think hold the most promise?
Yeah, so it's a good question. I mean, I guess right now, given it's so topical, it's easy to say that artificial intelligence and large language models and what you're seeing ChatGPT do, is just the start of it. Where, the last 6 months, you've really seen this massive change in the excitement towards artificial intelligence as such. What it can do is just phenomenal. And I think we're just at the edge of that. So that's obviously an area that holds immense excitement. From our perspective, we own NVIDIA in the portfolio, which has had a phenomenal run on the back of this excitement. We also own companies like ASML, who, are also in the value chain and set to benefit from the growth in all the chips and semiconductors that are needed to fuel the growth in AI. So I think that that's an area of excitement. I would say the healthcare space as well. When you look at the range of companies that we have, who are actually using things like artificial intelligence to dictate drug discovery, for example, putting experiments through these large models who can basically show you what drugs are have the best chances of targeting this disease. from our perspective, the opportunities are just so exciting, with these sorts of companies. So I would say in the healthcare space, where we're seeing the application of AI and machine learning, I think holds real excitement as well. And we're seeing some evidence of that already come through. But I would say that would be another area just to pick up on, would be the healthcare space.
Well, we've got time for one last question here, and we want to end on a nice positive note. So Claire, overarchingly for our listeners today, what are some key reasons to stay positive in this uncertain and really challenging economic time?
Yeah, I mean, I think, as I say at the beginning, I mean, it's been a difficult environment for growth stocks and Scottish Mortgage in particular. But if you strip away all that noise and you just take a step back and look at it, what is it Scottish Mortgage provides you? What does Scottish Mortgage give you that you can't get anywhere else? And I think that's really, for me, the excitement of this portfolio. You've got access to the most phenomenal growth businesses, whether they're public or private, whether they're in the US or China or in the UK or in Sweden. This is a portfolio that is looking at the most disruptive companies and industries all around the world. And I think that what we're offering our shareholders is access to these companies at a very, very attractive cost. It's very difficult to get access to these private companies in a vehicle at the same value that you could get with Scottish Mortgage. So I think, when we look at Scottish Mortgage as a whole, it's a very unique entity. It's got a very, very exciting portfolio of companies in there. And as I say, like I said at the very beginning, we don't see a massive break or change in those deep underlying structural shifts that we're seeing in these industries. And so I think that, despite a lot of the noise, that, massive progress has been made, significant progress has been made in some cases. And I think it's just focusing on the long term and looking at actually what these companies are delivering. They are delivering operationally, and I think that's what we're really focused on.
Excellent. Well, look, the time is ticking away, so we do have to leave it there for today. Thank you so much, Claire, for that fascinating presentation and for all of your insights with the questions as well. That is very much appreciated. Now, before we wrap up, let's just take a quick look at the learning objectives again, which are going to pop up on the screen for you now. Excellent. If you have a question today that didn't get answered, Claire and the Baillie Gifford team are going to do their best to do so after the event. And before we close up, just a quick reminder that your CPD will be delivered tomorrow. However, it will only arrive if we know who you are. If your Zoom account doesn't show your full name at the bottom of the screen, please write your full name in the chat now so that we can get that CPD to you. Lastly, before we close, let me just leave you with a quick little teaser of what's to come from PA Events. Our principal focus now is our brand new Professional Advisor Management Retreat in just a couple of weeks. It's on the 17th and 18th of May at the magnificent Wootton House near Dorking in Surrey. If you're running an advisor business with AUA in excess of 75 million, or you're a senior partner in that business, then this retreat is designed just for you. We'll be spending a day and a half in the company of some of the industry's leading lights. There will be plenary sessions from Bank Hall, who will be helping our delegates once again with consumer duty. We'll have former CEO of the PFS and now CEO of the newly formed Consumer Duty Alliance, Keith Richards. He'll be talking about vulnerable clients and also having an informal chat over dinner on the first evening. We'll also hear from Philip Martin of Unique Financial Planning in discussion with SEPL Chair Hugo Thorman about the business of white labelling platforms for advisor firms. And there will be a scary but really insightful session on cybersecurity from the ethical hackers at Mazars. Technical Connections' Tony Wickenden will also be there presenting a session entitled Tax and Estate Planning and the Role of the Onshore Bond. And we'll round off the retreat with a fascinating discussion on staff and client engagement as a business driver from specialist advisor business coach Rosanna Williams-Wood. On top of that, you can attend boardroom sessions from Albemarle Street Partners, Baillie Gifford, Benchmark Capital, GSAM, Orbis, and Time Investments. And all in all, that is a total of 8 hours of CPD, as well as some precious networking with your peers in one neatly tailored event. There's just a few spaces remaining, so if you'd like to come along, please register this week. Details of the retreat and all our events are, of course, available on the Professional Advisor website now. So that's it. Thank you to you, your readers, for your company this lunchtime. I hope you found this session insightful and interesting, and I look forward to seeing you again next time. Goodbye.